before I teach. So still a market update here. Take a look at your QQQ. Notice what happened yesterday. We obviously had a pretty big selling day. Not a huge surprise, pretty much what we expected coming out of Power Trader Sunday night. How many of you, after Power Trader Sunday night, you felt like you were prepared for yesterday and the reality that we were probably going to have a bearish trading day? And certainly we did. And today, notice the Qs. Notice how we have this long upper shadow here. This long upper shadow actually shows that we were somewhat bullish for a good portion of the day, but by the end of the day, that selling pressure came back in. As much as I hate to admit it, guys, I really think that 161, 162 is a very realistic target. Of course, that agrees with this Elliott Wave tool that you're looking at here, but that was something I had already targeted for you. Take a look at the way the diamonds and the Dow played out. Today was much more bearish on the Dow than it was on the NASDAQ, at least the way that it looked on the ticker tape. But if you look at the actual candles, you realize, yeah, both of them are kind of pretty similar here. Huge day yesterday on the Dow. Notice we're crossing back below these moving averages. Again, guys, I really think 244, 245, that's about 24,500 on the Dow index. But right here, this is your real support. Maybe as low as 24,000, maybe lower. So, you know, it goes against what I want to say because I want the market to be bullish right now. But right now, looks like the setup that we had Sunday night is playing out quite exactly. It almost makes it seem like I had control, but I didn't. I promise, I did not have control over the market. Just reading and interpreting what market signals are, and you know, maybe that's a good little segue here. You know, personal bias is one thing, fundamentals are one thing, what the news says is one thing, but really all that matters is what, guys? The only thing that really matters is what's actually happening. I personally think that November and December should be bullish. Seasonality-wise, it should be bullish. I personally don't think that this bearish swing we had in October is justified. I personally think that it was just a little bit of an overreaction, and we should have a bullish move taking place here. That's my opinion. That's my bias. If I look at what the chart is telling us, the chart is telling us that, hey, we still have some bearishness here. And that's really what I was talking about Sunday night whenever I called it, and I just called it clean, just as we see it. The candlestick formations in that location at those moving averages, all of it said bearish swings coming. And so, you know, I just say that to, I guess on one hand, I want to encourage you that markets are not as mysterious as we would like to give them credit for. It's human behavior ultimately. Ultimately, we're just following the herd and following the momentum. I think that, I don't know, it almost appears, I can't prove this because there's not enough hard data to prove it, but whenever it looked like and I don't mean to make this political, but it's going to come out political, what I'm going to say here. Whenever it looked like the Republicans were going to win the Senate and, you know, do pretty well in the midterms and all these policies were going to continue, the market seemed to react pretty positive to that. And now that you've got all this election stuff that's kind of up in the air, I don't know if that's the reason we're seeing this bearish reaction. I just think it's interesting that it all coincides. I guess that's my point on that. But, you know, to take it a higher fractal here, it really doesn't matter the why. The why does not matter. What matters is the fact that it's happening. And as a good trader, what you need to do is learn to recognize the patterns. Learn to recognize when the momentum is shifting. And that's really the key. And it does actually set us up well for what we want to talk about tonight, because tonight I'm going to get into class 3 of our calendar spreads here, which is selecting the right trade. So how many of you feel like you do a good job selecting good trades as opposed to those of you who feel like you do a cruddy job of selecting good trades? Anybody? Go ahead. This group, I need you guys to talk to me because I feel like I'm just talking to the wall. And if I want to do that, I can just record videos. So I just need you guys to like whip out your question panel and just start talking, because otherwise I'm going to feel really lonely. And I had a fallout with my dog. This is a true story. I'm already feeling a little sad because I had to beat my dog. And by beat my dog, it really wasn't that bad of a beating. It was just kind of like a little more of a little slap on the butt. But my dog pooped on my hat. literally on my hat. I was so mad at this stupid dog. She's 5 pounds, and of all places to poop, she took a poop right there on my hat. I was so mad. I am still mad. This was 3 days ago, and every time I look at her, I tell her, I'm like, I hate you. I hate you, dog. She just took a dump right on my hat. 5 pounds. 5 pounds of pure terror right now. Little mutt. I don't know where she went, but anyway, bottom line here, I need you guys to like chat with me because for some reason I haven't had a lot of turnout for this class, which is really surprising. And the way that I get energy for these classes is to have you guys chat. So that's the truth. I mean, the dog did also poop on my hat, which is just pathetic. Anyway, I'll get over this. Tonight we're talking about selecting the right trade. She was marking the territory on my hat. Yes, Joan, thank you. Thank you. Now you're defending my dog. Uh-huh. All right. Let's see here. Cheryl's laughing at me. Had a great little chat with Cheryl this afternoon. Cheryl, do you mind if I share some of that? I might work that into our talk tonight. Linda says she feels like she makes cruddy trades. Marcos says that he's had a history of bad trades. Marcos, tell me more. Linda says that's funny. Linda, I am absolutely deleting that comment. That was so mean. You cannot laugh at the dog pooping on my hat. It's a true story. I got out of bed. This is 2 days ago. Get out of bed. I'm walking into the bathroom, and I look, and that was what I was awakened to. The dog pooped on my hat. So mad. Still mad. All right. Yes, Jason, you do comment quite often. You do a good job, Jason. I wasn't complaining at you. Marcos says he has a history of bad trades. He's going to expand on that. Norm says market changes really have affected his trading. When you say market changes affected your trading, Norm, tell me more. What do you mean? It's affected your trading negatively. It's shaken your confidence. Tell me a little bit about it. Lynn says, if I was more responsible, I wouldn't have had my hat on the ground. Thank you, Lynn. I appreciate that word of confidence. James says, sorry about the dog. His dog would never do that. He hopes. Well, I didn't think so either, James. After 12 years, you'd think you know a dog, right? Jason is laughing at me. Phil says, sorry about my hat. It will survive. It will. Wait a second. She pooped on my Titans hat. And this was after the Patriots win. Could it be that my dog is a Patriots fan? Is that it? My dog is a Patriots fan and she pooped on my hat because she's mad about the Patriots and the Titans beat the Patriots for the first time in like 16 years? Oh, this is horrible. Jason says emotion gets in his way of picking good trades and sticking with it. That's a good one, Jason, and a very real one. Norm says has him feeling less confident about picking his trades. All right. And guys, all these emotions are real. They are, they're natural. I want you to recognize that your emotions that surround the stock market and surround your trading are natural emotions. So don't beat yourself up about it. Cheryl, if you don't mind, I'd like to get your approval before I share your story just a little bit. So just say yes or no. I won't divulge anything too personal. But guys, I want to encourage you that the emotion of your trades does not define you as a trader. Just let that sink in for a moment, okay? Whenever we think about success coaching, we think about the way that you have to have a mindset of moving towards success. One of the things we always say is your past does not equal your future. It's a very, very important thing to recognize. Your past does not equal your future. So Norm, think about it. Whatever has happened up until this point, it does not define your future. Sure, it helps craft who you are. It helps describe your story. It tells your journey, but it does not define your future. Okay. I want to also say that your emotions, the emotions you've had about your trades up until now, do not define your future, and they also do not define your identity as a trader. Just kind of maybe write that note down. My emotions do not define my identity as a trader. Just because you feel uncertain, just because you get focused in on thinking about the profit or you think about the loss, it doesn't define you as a trader. It's just the emotion that you're fighting as part of that particular circumstance. So I had a great little chat with Cheryl this afternoon. Most of you don't know Cheryl, but she's a Trade Smart student, been around for a while, and joined our mastermind group. And I just had a really great conversation with her about emotion in the trades tonight. Sorry, this afternoon. Had the conversation this afternoon. So tonight I'm going to kind of work some of that in, but let's start by talking about our actual class, selecting the right trade. And, because emotion is so important and because it does have such a defining role of the way that we place our trades and because the market's been so uncertain lately, I think it's going to be an interesting class to see where things go here. Yaz says, I used to select bad trades, get in the highest possible candle. Now I select good trades to get in, but I often get out at the wrong time. Got it. Yeah, that's first of all, Yaz, give yourself a little celebration. The fact that you've learned to enter better trades. Now you just got to fine-tune the exit. Fine-tune the exit a little bit there. Marcos says, in the past, I've jumped around from one approach to another. I trust that after the education I'm receiving here, this will improve. I've already placed a calendar spread in the Thinkorswim account, and it was a straightforward process, and I believe I did it correctly. Good for you, Marcos. All right, let's jump in, and I'll work some good encouragement in throughout the evening. Also, I want to encourage you guys, watch your email addresses, watch your emails. Thursday, you're going to see an email from me this coming Thursday. It's coming up in 2 days. You're going to see an email from me inviting you to participate in an end of the year 45-day challenge. And I'm also going to invite you to participate in a 10-day mental detox, 10-day mental diet. Watch your email. The actual challenge is going to start on Saturday. That's 45 days from the end of the year. So watch your email for it. If you do not see it by Thursday afternoon, then you can send an email to Rebecca. Otherwise, don't blow her up yet because she was like, people are asking me for this. And I said, it's not gone out yet. It's not gone out yet. But Thursday, my plan is to send it out on Thursday, and I'm looking forward to that. And what I'm going to do for the last 45 days of the year is I'm going to give you guys some group coaching from here to the end of the year on trading mindset, and we're going to do it every day. I'm going to send you something. We're going to work through it as a group, and I'm looking forward to seeing how all of this plays out. I think it's going to be great. So maybe tonight I'll kind of start dropping some of that. In this webinar tonight, we're going to talk about stock picking, talk about trading the right option. How many of you struggle to pick the right option? Talk about that tonight. Talk about which indicators to use and walk through the trade selection process. All right, let's do a 49-second review. We talked in class number 1 about various types of spreads, and we landed on diagonal spreads. This is what calendar spreads really are, is diagonal spreads involving two legs, both a long and a short leg, different expiration, different strike prices. Of course, the direct calendar spread is different expiration, same strike price, and vertical spread is same expiration, different strike prices. We talked about LEAPS options. LEAPS stands for Long-Term Equity Anticipation Security. It's a horrible acronym that only a trader would come up with. But what is a LEAPS? It's really nothing more than an option with a really long time to expiration, and technically speaking, we call that 9 months or more to expiration. LEAPS work just like a regular option after the 9 months is expired, or we're less than 9 months, I should say. When we're less than 9 months, we just refer to it as the option. So there's really nothing super special about it, except for it's been issued a long time in advance. We have LEAPS for both calls and puts. What's the benefit? Well, long-term options mean you have long-term control of the trade. With a call, you have the right to buy the stock. With a put, you have the right to sell the stock. You can use the calls to replace buying your stock for X number of months, or you can replace puts. You can buy puts, I should say, use puts to replace shorting a stock for X number of months. The example that I've been building on the screen for you is the January 2020 180 call. We say instead of buying the stock for 180, we could buy the January 120 180 call and have control of this trade for, at the time of the screenshot, about 18 months. And then we talked about the covered call. One way that we could place the covered call is to simply buy the stock and then sell the options against it. Cool ways to think about it: lower your dollar cost average, creates the monthly income. It's the ultimate dividend. It's one way you can beat the S&P every month. And so we took that same idea, the covered call, and instead of using the LEAPS, we say, what if we just buy the stock and then we sell the option against it? And we do that month after month, and that creates some nice steady income. And I want to stop here. I've said it several times. I want to say it again. If you get through this calendar spreads course and you say that seems too complicated, just come back here. Come back to the covered call. It's the exact same strategy. Same strategy, just a little bit different. That's all. All right. What's the strengths and the weakness? The strength of the covered call is it's a consistent way to make some money. It's fairly easy, fairly safe. The weakness, though, is it does require more capital to execute than the long option trade and the equity risk of the long stock going down. So we asked the question, how can you lower your capital cost? And the answer was, well, what if we buy a LEAPS option, go back to that 180 January 2020 call, What if we did that instead? We now have control of this stock. Instead of putting up 180 bucks a share, we've got control for about $18 a share. We can turn around, sell that 183 call, bring in the income, keep doing that every couple of weeks there, and you got a nice little cash cow, right? And that's why we refer to this diagonal calendar spread as the poor man's covered call, which I've got coming up if my slides would finish building, but my mouth and brain are going way faster than my slides. There it is. Poor man's covered call. Norman, are you here tonight? Norman and Cindy. I don't see either of them. Unless Norm is the same as Norman. Norm, are you the same Norm that goes with Norman and Cindy? All I see is the first name. All right, I think it's a different, I think it's a different one. Okay. He says no. All right. Thank you, Norm. Appreciate that. Since Cindy and Norm are not here, I will not speak to him about this issue. Otherwise, I had a little message for him that pertains to this slide. All right, so the calendar spread, poor man's covered call. Notice in the red, I've got the January 180 2020 call. We pay $18 for it, and then we want to sell a month, roughly, a month's worth of time all the way across there, bringing in approximately $1.40 in this example over time. Now, the blue lines that you see curved, that's your time decay. So across the bottom, you see the time decay of the January leaps position, and very slowly over time, it does decay. But what we're actually making money on is that very rapid time decay of the shorter term option. So we spent some time in the last class about talking about time decay and how shorter term time decay decays faster. All right. Then I gave you my mic drop, which is cool, but I really set that up better the first go around. All right. Let's talk about selecting a good stock. I'm sorry. I'm a little bit ADD tonight. I don't know why. I'm just a little ADD. So stock market has lots and lots of stocks out there. How in the world do we know which stock to trade? Norm says, do tell me about Cindy. Well, Norm, Cindy is married to a guy named Norman, and they're a great couple that are part of the Trade Smart family. So Norm, that's who Cindy is. All right. Over 3,600 stocks to choose from, over 2,100 ETFs. Let that one sink in for a moment. There's over 2,100 exchange traded funds. How in the world do you decide? So here's kind of a rough checklist. This is not black and white, but it's a really good guideline for you. Number one, good volume. 1 million plus average daily volume is a good place to start. Number two, the price. I suggest $20 or more. Jason Smith, if you want to do collars, I definitely suggest that you do a $20 or more trade. Don't be doing collars with a $9 stock. You're not going to get the kind of income you want. So Jason, well, all of you, if you want to do a collar trade, I would definitely suggest $20 plus. With your leaps positions, honestly, the ones that I like are even more than 20, but I have found some really good trades with $50 to $80 stocks, some really good trades with the $150 stocks and whatnot. So that's another cool thing about the leaps is because, well, you get much less than 20. Let's just put it this way. If you get much less than 20 on your leaps position, it's cheaper to just buy the stock. Just buy the freaking stock. And there's a lot of value in doing that. So $20 or more, good price movement. It needs to be optional. Optionable is what that should say. Optionable. Not optional, optionable. I think that is called a spell check error. Optionable. I probably left a letter off and it turned it into optional instead of optionable. It needs to be an optionable stock. Now, what does that mean? There's several stocks that are not optionable. They don't sell options on them. So that's an issue. And then a good open interest, option open interest. I say 500 plus open interest, and that's for current month. That's for current month. There's a good chance you will not have that on the leaps position. Good chance. The TradeSmart 150 usually meets all of those criteria, so that's a good watch list to start with. Primarily, I will be pulling from that list for Power Trader and for other TSU-related classes. Let's talk about the analysis part of this. This is where we get to the good stuff. All right. Whenever we're dealing with a calendar spread, I am of the philosophy that we should only trade bullish trends. And let me explain that to you briefly. By the way, this is my philosophy. I'm not saying that this is the gospel truth. I don't know that it's the right way. It's just my philosophy on this. My theory is this. Leap options are long-term positions, right? Since leap options are longer-term positions, we expect to be in them for several months. How long does a typical bear market last? How long does a typical bear market last? Eugene seems to think I'm a hyper tonight. So Eugene, please give me my answer. How long does a typical bear market last? Less than 18 months for sure. Typically, it's about 3 to 5 months. Yeah. Big bear market, like 2008, 12 to 18 months. Okay. What are the odds that we're getting into a bear market? At any given time in market history, what are the odds that you're at the beginning of an 18-month bear market? Relatively low, really quite low. So in other words, when you're placing a leaps position, it is naturally a bullish type of a trade. Naturally. And since the market over a long-term outlook tends to be bullish, I personally am of the theory that we should only buy bullish trends that fit the bullish bias. Otherwise, what we'll be doing, yes, you could do this strategy with puts. You can do that. You can do put calendar spreads. But the challenge with that is you've got to time that just perfect for the big 15 or 18 month bear market, which doesn't happen that often. And so that's why I say from an analysis standpoint, let's gravitate towards the bullish trends. Some of you are saying you're not getting the notebooks. So let me find it for you really fast here. Stand by. Stand by, stand by. Are you guys not getting the email with the notebook? Did that not come out? While I look this up, I'll answer some questions. Eugene is concerned that I'm back on the Dr. Pepper. Well, Eugene, I'm actually really tired tonight. Maybe that's why I'm ADD. I don't know. I just have a lot on my mind, Eugene. I get a lot on my mind. Sometimes I get off my slides. Jason says one of his questions about the collar, what price to shoot for? So greater than 20 and less than 80. I did not give you the higher end there. I said greater than 20. But yes, probably less than 80. That's your boundary, not mine, but it's probably a good one. All right, this is calendar class 3. Here it is. All right, here you guys go. All right, so there you can download the notebook and you can have that. All right, let's jump back over here to my analysis. My first principle of the analysis is bullish trends only, and I just explained to you why. Because when we're doing a leaps position, we're expecting to be in it for at least 12 to 18 months. Well, generally speaking, over any 12 to 18 month period of time, you're probably not in a bearish trend. You might have a bearish swing that might be a month or two, maybe 3. If it's a big one, it might be 3 or 4 or 5 months. It has to be a 2008 to be much more than that, just statistically speaking. It's just probably not going to be there. So that's why we want to gravitate towards bullish trends. What happens if it's not in a bullish trend? If it's not in a confirmed bullish trend, what do we do? If it's not in a confirmed bullish trend, what should you do? Pass, right? If that's part of our analysis checklist, hey, we're looking for bullish trends only. If it's not in a confirmed bullish trend, we just pass. It's that simple. Okay? Leaps to long-term positions, I just explained that. Rarely do you want to take a long-term bearish position. I just explained that. Bears are also not that scary. How often do you short an extended period of time? And the answer is not very often. Not very often. Average bear market lasts about 15 months with a 32% sell-off. That's the big ones. Those are the big bear markets. Okay. Every year, there tends to be a bear market, by the way. In general, an 8 to 10% correction happens on average once a year. 2018, we happen to have 2 of them. But in general, on average over time, 8 to 10% correction happens at least once a year. Okay. Odds are that the correction will happen between May and October. Did we just see that? Yes, we did. September and October are the worst months to trade. Over time, the market goes up every 20 years, right? Well, that's good marketing copy for for mutual funds. But the truth is, over time, if you time it well, the market does tend to go up. The market as a whole has a bullish bias. I don't like this whole theory that market goes up every 20 years because you do have to time it a little bit better, but we can time it using our timing tools. So your key is to optimize and manage for the big picture primary trends. And in my opinion, you don't need a position for the bear trends. Rather, you just manage them. And we'll do that with the hedging, which is my next bullet point here. We can do that with hedging. Long term, what we want to do is we want to build around a bullish bias. This is the key right there, okay? Build around the bullish bias. Susan, did you get your notebook? Paul Sadath wants to know, when we set our target for the covered call, should we say use 20% of what we sell it for? This will allow us to take our profit and open another covered call. Has anyone tested if we could? Okay, Paul, you're starting talking about setting a target for buy to close for the covered call. Ideally, I try to buy to close it for a nickel or less or let it expire worthless. The only time that I set a specific percentage is if I get to double what I received for it. That would be a trigger to close the trade, more of a stop. Okay. So how are we talking about picking the stock here? Here's my punch list for you. Pick a decent stock. Start with a TradeSmart 150. Verify you're in a bullish trend with your moving averages. Next, confirm with some indicators. And then verify that your option premiums are decent to sell. And then verify that your leaps have some decent volume and open interest. And if you do this, you'll probably be okay. So there's your checklist right there. No, it's kind of bouncing around a little bit, but there's your checklist. How many of you think you can do this? I think all of you can do it. Norm, you say you've been struggling a little bit with recent market volatility. Who else has been struggling? Who wants to be a guinea pig for me tonight? Who's been struggling just a little bit? Okay, I'm going to give you some examples, and then we're going to go pick some. Real time. Anonymous attendee. I don't know who you are, but anonymous attendee has been, that's the way your name came up, has been struggling just a little bit. Anybody else who's been struggling and wants to be a guinea pig? Take a look at this picture. This is a good candidate. Why is it a good candidate, George? George, why is that a good candidate? We're above the moving averages. It's pulled back. It's bouncing up off the averages. You see the continuation patterns through there? This is a good candidate. It's been an established trend. Generally speaking, that picture will not yield bad results. Okay? Apple, this particular picture, pretty good candidate. Okay, maybe a little bit high, a little bit overbought, but pretty good candidate. And by the way, this was in August, and it did go up another $10 or $12 before we had our selling that we currently are dealing with. Is this one a good candidate? Yes or no? I have a green sign that says good candidate, so I guess you should probably just say yes. The reason this has got some good potential to it, let me just explain it to you, is because you're bouncing up off of support in an established channel. So even though you're below your moving averages, your pattern, there's a pattern there that suggests a good little bullish move. It's a fairly safe candidate, relatively safe candidate. Okay. What about Facebook on this particular picture? Why is this a bad candidate? Somebody tell me why this particular picture is a bad candidate. Phil says if you buy a leap, you don't own the stock, so you can't sell the covered call, right? It's more like a naked call. Wrong, Phil. When you buy the leap, you now have the right to buy the stock, so you are actually covered and you're no longer naked. Emperor got some new clothes. I'm just kidding. Low volume? No. You're welcome, Phil. Below the moving averages? Yes, but so was, let's go back a screen here. So was Micron. Micron was below the averages, and I told you the reason Micron was a good candidate is because we were at support in a channel. Look at the patterns, guys. Look beyond the averages. Why is this not a good candidate? There's not an uptrend. That's right. But look, we had our bearish gap. We rallied to the averages, and then we continued the sell-off. See, that's a bearish trend confirmation right there. Way too risky. And what your emotions will be tempted to do, your emotions will be tempted to say, oh, it's Facebook. It's going to go up. Where's Facebook today? This was in August. This is in August, and I was telling you based on that picture, I said, no, it's not a good trade. Where are we at with Facebook today? We'll just look at where we went next. Here was the picture. This is where I said it was not a good picture. Remember August? How did I know? I knew it because of the pattern. We were below the averages. We sold off. We rallied to the averages, and we started to continue the sell-off. Now, this was before the October sell-off. Remember, if you look at the overall market, the market was rallying during this time. The market rallied all the way through September. Here, I'll show you. See, this was what the market did. Here was August. Here's September. The market, this is the Dow Jones, continued to rally all the way through the first couple of days of October, but not Facebook. How did I know that Facebook was not going to be a good bullish candidate? Because we were fighting the trends. I mean, I cannot emphasize enough what a simple principle this is, and yet it's a principle that most of you tend to ignore. Once you drop below the averages, that alone is a bearish warning. If you rally to the moving averages and start to continue the sell-off like we had here with Facebook, stay out of it. So this was back when Facebook was 169, 170 bucks a share. And between here, approximately where I took that screenshot, and where the market peaked, Facebook was down another 10 bucks a share. That right here, where I just drew this arrow, that's where the market peaked. But Facebook did not. Facebook was already well down that mountain. Okay, so you guys see the picture now? Let me come back to my slideshow. Where are you, slideshow? Forgive me for sniffling. Weather's changing in Nashville. It's going to snow tonight. See, that's the picture. Sorry, it was white over here, so maybe that threw you off. But this is why this was a bad candidate. Now, Micron, in fairness, while the setup was not bad, in fairness, let me just come back since I took these pictures. It's always nice to come back and see what actually happened. Micron did continue the bearish sell-off. Now, this was the... come on, chart. There we go. So whenever I took that picture, this is where we were. And by the way, it worked for a little while. But notice what happened with Micron. That was the picture that I told you was a good buy. Remember? We rallied on up to 53, but then we hit that 50-period moving average. Selling pressure came in, and boom, Micron's just been downhill ever since then. And it's sad because I really love this trade, but it's just not a bullish trade right now. It's just not. I like the stock a lot. We've had a lot of fun with it, but it's just not a bullish trade right now. So it's not a good candidate for a leaps position. You guys tracking with me? But at the time, it was a good picture. At the time, and I'll come back and show you that. Is this beneficial for you guys to come back and see what I was looking at and how things played out? So this is what we were looking at the time. See those 1, 2, 3 green candles? And we did end up rallying up to about $53, $54. We rallied right up to there before we got the selling pressure. So, under most market conditions, this would have been a bullish trade that would have gone back to 62.50. Most of the time that would have happened. It just so happened in this particular scenario, the market was kind of setting up for this bearish move that was on its way. But that's what I was looking at the time. Okay, so bottom line, that was actually a good candidate for a leaps position. This Facebook trade was not. Take a look at this GoPro trade. It's above the moving averages. Why is it a bad candidate? We've got over 1 million shares. Why is this a bad candidate? Marcos says, in addition, Facebook had a lot of bad press. And thank you for saying that, Marcos, but I'm going to help you let that belief release a little bit out there. Most people believe that the news is what drives the market, and it doesn't. See, the sentiment was already telling us what was happening. The sentiment was way ahead of the negative news here, Marcos. And that's why I say all you need to do is read the chart. Just read the tape. Read what's there. Okay, so Daryl says, don't do it because it's flat. Let me come back. Jason is the one that got it. He said it's because it's below $20. You got it, Jason. It's the price range. Now, why would a $6 stock be a bad leaps trade? Any ideas? Why would a $6 stock be a bad leaps trade? Joan says it's because it's not holding above the averages. But Joan, technically we're selling the option. So if it's going sideways, can that be a good leaps trade? It can be. It can be. Yep. Liquidity could be an issue, but the bigger issue is the cost. We can go buy the stock for $6.54 a share. If you buy it on margin, how much is it going to cost you out of pocket? If you're going to buy a stock on margin, it costs you 50%, right? So you can buy this stock for $3.25 on margin. Do you have leverage with margin? Yes or yes? So now we've got some leverage, which is the primary reason most people trade options. You want the leverage. You can actually get leverage and buy this stock on margin for $3.25. The leaps position for 1 year out was $2.30. For $1 more, you own the stock and there's no time decay. For $1 more, you own the stock and there's no time decay. That's why the cheap, inexpensive stocks aren't worth it, because you end up paying so much money for premium over a couple of years or 18 months or whatever for your leaps position. Turns out we actually had on GoPro, we actually had decent open interest. We had 808. And look here, Cheryl, for this 750, we had over 6,000 open interest. We actually had decent open interest. It's just that the cost was not a good value. You could buy the stock for on margin for $3.25. If you want to buy it full cash, only $6.56 a share. So it just doesn't make a lot of sense to take on the additional risks of options simply to have an extra dollar worth of leverage, because how much of this $2.32 is going to expire over time? How much is going to decay over time? Quite a bit of it, right? You've only got $1.50 of it is intrinsic value. So you've got $1 of it that's going to disappear over time, which is 50% of it. 50% of that premium is going to disappear over time. Whereas you can buy the stock for on margin for $3.25, sell the monthly premium for a covered call and bring in 19 cents on it, 50 cents out of the money. You can get the same premium from the calls, but now that underlying position will never expire on you if you own it. So that's why I say if it's a cheap stock and I put the line there at $20, it doesn't make sense to spend the money on the leaps position. You're spending way too much for premium and you can just buy it for cash. Okay? Remember this. People put so much energy into picking the right trade, but remember this, being a trader is less about picking the right stock, and it's much more about how you trade that stock. Less about picking the right stock, more about how you trade it. And the difference that makes the difference is you. It's your skills. And here's my encouragement. Don't become paralyzed. Don't become paralyzed. We get so caught up in, am I making the right decision? We get so caught up in, well, what's the news? Well, what's this? What's that? And we're focusing on the wrong thing. You guys have got way more skill than you realize. You have way more ability than you realize. You have way more answers inside of you than you realize. You just have to learn to trust yourself a little bit more. Paul says if Facebook is going down and you buy the put to protect yourself, then all your covered calls will expire worthless. You make money because the leap is going down and the covered call is going down, so you gain on both the put and the covered call. You are correct, Paul. However, if you're doing it with a leaps position, if you're doing it with a stock position, you still have your equity. If you're doing it with a leaps position, you'll end up with an out-of-the-money leaps, which is difficult to sell your options against. All right, so which options do I use? Well, here's how we're going to start. We're going to start with at the money. Start with at the money. We're going to look at one or two strike prices in the money. You're going to look at the cost and the volume. And as long as the underlying stock trend is good and the price is reasonable and the volume is reasonable, you should be okay. Okay, now I know this is somewhat nebulous, but it's really not. It just feels nebulous. That's how much you guys have been overthinking it. At the money, this is where you want to start. Start with at the money, go one or two strike prices in the money, and I'm going to add one in here. You could go as much as 5 to 10 strike prices in the money. This is one of the things that we discovered in our mastermind, and I'm going to talk about this more Thursday night. Woo, it's an M, ITM, in the money. We discovered the deeper in the money we go, the more friendly it is in a bear market because the hedge works better. So Paul, that's something that you'll discover if you hedge this thing right. The hedge works phenomenally great if your core position is 5 or 10 strike prices in the money. I said 5 or 10 strike price, $5 to $10 is what it really should be. $5 to $10 in the money. All right. But as long as the underlying stock trend is good, as long as the price is reasonable, as long as the volume is reasonable, really, if you're at the money or one or two strike prices in the money, you'll be fine. You really will. All right. What about the short-term options? Price 2 or 3 out of the money strike prices. This is not a black and white rule. That's what BW is, not BW, not black and white rule. Price 2 or 3 strike prices out of the money. You must be able to pay off the leaps premium within 10 to 12 months. And I say you must. That needs to be your rule. If it's 13 months, it's not the end of the world. But you really want to be able to pay off that leaps premium. And liquidity is very important for your short-term option leg. Good open interest. You want to be able to get in and get out. In most cases, expect to collect about $1 to $2 per month of premium. About $1 to $2. Yas says, should volatility be a factor in selection criteria for a good return? Not in and of itself. You can just look at the dollar numbers. You don't have to be getting as granular as volatility. I will say if you're in a bear market, you'll have higher volatility and you will have higher premiums. But in and of itself, if you're getting the $1 to $2 per month, you should be all right. And you don't have to necessarily think about the volatility. All right, let's go do some examples. And I'm going to show you guys, you know more than you thought you knew. Who's got a stock you want me to look at? Start with American Express. I've already got all this on here. Shoot. Let's go to, well, actually, you know what? Let's not. This is a trade I set up with the mastermind about a week and a half ago. I will explain these positions to you, which don't quite follow my rules, but I will explain it. Ignore the puts for now. Ignore this because I have not taught that to you in this class yet. So ignore that. Notice what I've done back here. We went several strike prices in the money. Price was way down here. We went down to the $90. So I went $5 to $10 in the money, right? This was part of our experiment. What happens if we go deep in the money? And then we're selling our call options way up here. Okay. So that's what those numbers are. And then we've hedged it in the middle. Since I haven't taught that yet, I just realized I should not use this as an example. But here's what I will show. Even in the face of the bear market, because this was already set up as a bullish move, look at how well it's done. And even today, we've got a bullish candlestick formation. Okay. Let me find a different one in here that we haven't set up yet. Nope, that's not a good one. Who's got one that's above the averages? Apple. Apple's below its averages right now, Phil. Yeah, sorry. Maybe it'll stop falling soon, but it's okay. Actually, I shouldn't have said that. Hey, Phil, what do you think of Apple? Based on my criteria, what do you think of Apple? It's below the averages, right? I already told you the answer. All right, let's check out Walmart here. This should be a good one. So I love everything about this Walmart trade, especially when I set it up in Power Trader. That was a really good trade setup for us. It's gone a little bit far, but we can still set this up and we should be able to get some good numbers for it. So let's just set this up for the purpose of setting it up. It's not the ideal timing, but it's not horrible. It does fit our rules. We're above the averages. We've pulled back to the averages. In a perfect world, it would be more of a setup like I give you in Power Trader. Most of the Power Trader setups are great actually for the leaps positions. Most of them, not all of them, a lot of them are. So let's just start here. So stock price is currently at 103, right? So let's come out here and we could buy the stock for $103 a share. It's one thing we could do. We could buy. If we wanted to buy 1,000 shares, how much is it going to cost you, Stephanie? 1,000 shares of Walmart. You can get loaded up. Falling prices, only $103,000 if you want 1,000 shares. If you do it on margin, it'd be $52,000, approximately $51.50. All right, now let's go out here and let's look at the leaps position. So what we're going to do is we're going to go way into the future. Let's start with January 2020, and then we'll look at 2021. And if we come way down here to January 2020, we got 430 days to expiration. Do you think Walmart, there's a good chance Walmart's going to go higher the next 430 days? Pretty darn good chance. I can buy a $100 leaps position for a mere $12 a share. And by the way, is there good open interest? There's great open interest, 3,000. You're going to notice on the volume for your leaps positions will usually be quite low. So you see here 18 traded today, not very many. We have really good open interest on this. You'll have plenty of liquidity, and it's only $12 a share. So how much can we do this one for? 1,000 shares, Stephanie. Only about $12,000. So Stephanie, would you rather ante up $12,000 to get control of 1,000 shares of Walmart, or would you rather ante up 103,000? Well, probably 12,000, right? Now, here's the issue, and this is one of the things that I wanted to run through with you guys that we discovered in our mastermind. At $100, if that's our strike price, what's our intrinsic value? Current price of the stock is 102.94. We'll call it 103. We have $3 of intrinsic value, right? So what is our, assuming you have the right to buy at 100 and the current price is 103, if the premium is $12.80, $3 of that is intrinsic value. What is our premium value on this? Somebody? What is 12 minus 3? Is it still 9? I think it's still 9. That's what I learned when I was a kid. So $9.80 of PV, we're going to call that premium value. This is the amount of your option that will slowly decay against you over the next 12 months. That's what you've got to offset with your option selling. So if you divide that by 12, what do you come up with? $9.80 divided by 12. You need to bring in a minimum of 81.6 cents a month. $0.81 a month, call it 82 cents a month to offset your premium. Make sense? You got to at least come up with that. So let's see, can we do that? If we were to go to current short-term options, we've got 10 days to expiration. Could we go out of the money just a little bit, maybe to 105, 106? And in the next 10 days, could we bring in at least 82 cents? And the answer is, wow, yeah, we got $1.22. Now, I happen to think we've got earnings coming up on this, which is why this is a little higher. Let me check. Yes, we got earnings coming up like this week. So these have got higher implied volatility. So right now you got a 39 volatility. That will go down next on Friday, the day after earnings. That will go back down. Let's look and see what our historical volatility is on this, because that's going to skew our numbers here. See, right now our volatility in this is 29. When everything stabilizes, it should be back around 18 to 19 probably. So expect 10 points of volatility to come off of that. But it doesn't matter for now. Just recognize you can bring in $1.22. Let's go out a month and let's see, could we bring in $1.60 over 2 months? Let's go to January. This will be a little bit more of a fair test. And let's say you came to the 110, and the answer is yes, you could. So about $1.40 over 2 months. That's almost $1.60. With the extra intrinsic gain, we would definitely be there. So that would be totally fine. So the answer is yes, we can make this work even with the, and by the way, look at these implied volatilities. I know I'm kind of going fast. 60 days out is not going to have the volatility spike for earnings. So you see we're at 22 here as opposed to 39 for these November options. So I know I went fast through that, but that's why I went so far out. I just needed to kind of test that, see if these numbers would work. So those numbers would work. Walmart would be a good trade. Now, here's the thing I wanted to run through with you. Well, let me set that trade up first. Okay, so if we were to buy this trade, the numbers that I just ran for you, forgive me for sniffling. It's stronger than me tonight. I don't want to be sniffling. It's there. So this is, we're going to buy, actually, sorry, put it right here at $100. And I want to make that a big old line. Let's make it, what color would you guys like this one to be? Maybe make it, I got a negative slope color. Make it positive slope. There we go. Make it blue for now. And let's put our notes on here. We're going to buy. Buy our January 2020 call, $100 call at $12.80. Well, that font didn't show up very big, did it? Make it big enough that old people like me can read it. There we go. Hey, that's our leaps position. That's our core position. And we got $3 of intrinsic value on that. Oops. Isn't that what I meant to do? My $100 marker. There we go. Let's put, what did I say? 110? Now this is, I'm going a little further out. Actually, let's do this. Here's the truth. Over earnings, I wouldn't do this trade over earnings. I would wait until earnings is done before you sell this option. But if we were to do it, can't seem to get my mouse to think with my brain tonight. Come on. Oh, I think the whole thing froze. That's the problem. I froze the whole thing up. Let me click around, see if I can't. There we go. There we go. I knew that we'd get this thing working. All right. Make this thing thick for us. And let's call this one green. And this is going to be Now, I went a little further out of the money, and I did that because I'm doing much more time on this one. Normally, what we would do is we would go a little bit closer, like maybe December, about a month's worth of time. But based on my example, I gave you a little bit more. What am I doing to mess my mouse up on this? It's clearly user error. There we go. All right, so there's your core position. Sorry if that was painfully slow to watch. Buy January 2020 at $100 call, spend $12.80. Sell the 2019 $110 call at $1.40. Now, if this trade comes all the way up here to 110, how much intrinsic value did I just get? I just added an extra $7 of intrinsic value plus my $1.40. That's $8.40. I've almost covered all my premium at that point. Okay. So that's why I say you'll be able to pull this off. Again, don't take this trade. If you're thinking about doing it, don't do it until after earnings. And this would be a virtual trade because you guys are new at this. But anyway, that's how we would set this up. Now, let me show you something else that I wanted to talk through. If we go deeper in the money, let's look at this. So that was a $100 position. What if I went down to 95 or even 90? Well, look, I can get control of this position for $20 at $90 a share. If the stock is currently 103 and I have a call at 90, what's my intrinsic value now? 13, right? So I've got a $13 of intrinsic value built in. Out of my $20 premium, that means I've only got $7 of premium value. If I were to buy the $90 call and sell the 110 call, which would add my $7, I've recovered all of my premium. And even if I get called out, I can't lose money on it. So that's one of the little nuances that we figured out is if we go $5 or $10 in the money, then it actually makes breaking even way easier on the premium side. So that's just a little nuance. There's not a black and white rule on this. And this is one of the things that our mastermind, some people said, hey, I like spending less money and I'll take the extra risk. Some people like having the extra intrinsic value. Intrinsic value is your friend. You need to know that. Intrinsic value is your friend. You can work your way kind of through these. If you did the $95, you could probably get filled on that for about $16.50. And that is how far in the money? So 95, 103 minus 95 is $8 in the money. So you've got about $8.50 of premium, which was not that much better than being at the money. So, which one's better for you? Ultimately, the one that's better for you is whenever you can offset all of your premium. That's the one that matters. And so whichever one you're more comfortable with, if you're more comfortable trading in the money, it makes a lot of sense to do that. If you're more comfortable trading at the money because you want to put less money on the line, I can appreciate that. I don't think it's a black and white rule. Out of the money is going to be harder and harder. The further out you get, the harder it is to make this thing work. So at the money or in the money is really where you need to be with this particular setup. All right. Have I exhausted that? I know it's kind of scattered because I was trying to set that up and fighting the software a little bit here. Let's look at another trade. How are we doing on time? 8 o'clock. How many slides do I have left? Stand by, guys. I need to see what I got left to teach you. We're on slide 36. It's just a checklist. All right. Let me go through another couple of examples. Norman had asked about Verizon. So tell me, Norm, is Verizon a good trade setup? What do you think? Does it fit the criteria? Actually, let's do this. Before we do that, let me finish my slideshow, and then we'll go through the checklist, and we'll do this at the end, Norm. We'll do more examples. All right. What about indicators? I cannot emphasize this enough. Don't overthink it. Don't overthink it. Don't overthink it. I'm telling you what, guys, unless you're brand new to trading and unless you're brand new to TradeSmart, the portion of picking a trade, it's already in you. It really is. It's as simple as follow this checklist of make sure you're above the moving averages. It's just that simple right there. Don't overthink it. However, moving averages, that should be your only indicator. It could be. If you want to add something, look at your oscillators, candles and chart patterns. Those are bonuses, but don't overthink it, guys. Okay? I don't even need to give you an example on that. Just remember, don't overthink it. Now, let's walk through the trade, and let me give you the blueprint. Did Chris send this out in the email? I definitely need to make sure you guys have this. So stand by. Let me put this in here. You need this blueprint. All right, so here's the link. Oh, I just sent that to the panelists. Hold on, panelists and attendees. There you go. All right, there's the link for this checklist that I'm called it a blueprint. I meant checklist. Here's the whole thing. Let's go through each portion of it. You ready? Number one, step one, pick your stock. This is all I'm doing is just walking through what I just talked about. Pick your stock. Step one. Decent volume, 1 to 2 million a day. Optionable, 500 plus open interest, implied volatility, 20 plus. This is ideal. Avoid a bear trend. Avoid pending negative news. Avoid expecting explosive growth. If you're expecting explosive growth, you can buy the leap, but hold off on selling the call until after the move. And then if you're getting into earnings, avoid earnings. Step two, analyze the direction. Look at support and resistance, moving averages, stochastics or other oscillator. Don't overthink it. Which direction? Are we bullish, neutral, or bearish? If you're neutral, you can take the trade. If you're bullish, you can take the trade. If you're bearish, avoid the trade. It's that simple. Step three, buy the leaps position, the leaps call. Buy into a trend or after a solid base is established. Buy at the money or 1 or 2 strike prices in the money, or alternately, you can go $5 to $10 in the money. Verify you've got decent open interest and you need some volume. Your leaps volume is going to be low. It may be 10 or 12, but you need at least some volume. If you consistently see 0 for your volume, it's probably not good for your leaps. Sell monthly or weekly calls. That's kind of part 2 of step 3 here. Must have the same shares secured. Must have the number of shares secured. That's the previous step, of course. Sell 2 or 3 strike prices above your current price. 1 to 4 weeks to expiration. Just run your numbers and see which ones you like the best. Sell the same number of contracts as you have in your leaps position. Step 4, exiting the trade for a profit. Method 1, assuming the trade stays out of the money from the call that you sold, Paul, you can just let this thing expire worthless. Method 2, set a limit order to buy to close the call at a cheaper price. Usually that's going to be between 1 and 5 cents. Turn around, sell another set of calls at a higher strike price if the underlying movement justifies it. If not, sell the same strike price with a later expiration. Method 3, if you have to adjust the trade. If the underlying increases and the short call reaches 2 times your premium received, buy to close the call at a market price, sell 2 to 3 strike prices out of the money higher. Now that's going to play with your psyche, but I promise you this will work. You're making money even though it doesn't feel like it for the moment. If you're in a strong trend, you might wait a couple days until the trend slows down and then sell your next set of calls. Okay. Let's talk about money management, position sizing. Don't tie up more than 20% of your account with any one trade. Normally I say 10%, but because we're going to put the hedge in here, you can go up to 20%. Break a $10,000 account into 4 positions of $2,000 each. Keep at least $2,000 liquid. So you notice you're basically dividing your account into 5. You take up to 4 positions and you keep enough to buy yourself out of trouble liquid. And then scale that ratio with your account size. Minimize your losses. Prevent yourself getting called out. See step 4 of method number 3. So come back over here. Step 4, method 3. That's how you prevent yourself from getting called out. Hedge yourself by purchasing 1/3 of the leap's time with a put. In other words, 4 to 6 months to expiration if you bought 18 months on your leaps, I should say. And then we can sell a lower put to finance the hedge. That creates a debit spread. I will talk about this in a moment. I know you don't know what that means yet. If it's bullish, if the bullish trend reverses, if it turns into a bearish position, you can flip the position and sell against it. Or as we found with the mastermind, really the easiest thing to do is manage the hedge, take your profits, close everything out, and just reposition. That's really the easier thing to do. It gets complicated after you start dealing with 4 legs. And I know you haven't talked about 4 legs yet, so I'm giving you a foreshadowing. Some of these last couple slides and this next one is part of what we're getting into for the next class. So this is foreshadowing class 4. This is the structural design of the strategy. Your blue line, that's the leaps call. That's your core position. We're going to sell the short call against it. And then we're going to hedge it with about 1/3 of the time for your leaps position. And then we're going to fund the hedge by selling a short put. This is a very complex alternate version of a collar. You do not need to understand this slide right now. I'm not going to answer questions on it. I'm just let it sink in. Thursday night, I will unpack this. In fact, this whole punch list, I'll unpack more of it Thursday night. But this right here is the structural design that we are building towards. Okay? So let me run through it really fast again. Here's your checklist. Decent volume, 1 to 2 million shares a day. Optionable, 500 plus open interest for your short-term options. Implied volatility, 20 plus is good. It's not necessary, but it's good. Avoid a bear trend, avoid pending negative news. If you're expecting explosive growth, maybe buy the leap, but hold off on some of the calls until after the move. Explosive growth would be something such as it just broke out of a pattern and you're thinking, hey, this thing's going to run $10 or $12. Let it run $10 or $12 and then sell your calls. If you got earnings, that's another reason to avoid the trade. And by the way, if you're in the trade over earnings, it's not bad. Just make sure you're hedged. Just make sure you're hedged. Barry, I just said I'm not going to address the issue of the hedge yet. So I will talk about that Thursday night. Because if I go off into that land tonight, we will all be swimming. Well, I won't, but I don't want to have to rescue everybody. I haven't taught that yet. I just the way this class laid out, I kind of had to get it out at some point because it's part of the checklist. So that's why I had to kind of at least show you the structure. Step 2, analyze the direction, support and resistance, moving averages, stochastics. Which direction? Bullish, neutral, or bearish? If it's bearish, avoid it. Step 3, buy the call position, the leaps. Part B of step 3 is sell the calls. Step 4 is your exit plan. And then money management is the 5th box. It's not really a step, but it's your 5th box, okay? Oh, you're not going to be here Thursday. It's already recorded, Barry. Barry, I didn't mean that personal. Forgive me if you took that personal. Although I could turn this into a personal attack. No, I'm just kidding. I just don't want to dig off into the hedge yet because I'll lose too many people. But Barry, if you can't be here Thursday night, there's already a version recorded in your membership area. You can go watch that version. And then I will record Thursday night as well. All right, let's go do another trade setup on this and kind of walk through this whole checklist here. Oh, Barry says it's okay to attack him. He's a 3rd-degree black belt. But that doesn't mean you're an emotional black belt, Barry. That means that you can kick somebody's butt, but it doesn't mean that you want to take those, fiery arrows from my insults. No, I'm just kidding. Who's got a stock that has just recently broken out in the last day or two? Let's go down. American Airlines right there. AAL. Let's do this one. So this is the type of a setup that I'm looking for. where the averages are crossing. This is better. The Verizon's okay. It's just been in that move for a while. You see how American Airlines is the moving averages are crossing up. I like this candlestick today. If this has any follow through, this is going to be a good trade. Okay, so this is the kind of trade that I would consider. It's relatively inexpensive. It's only $37 a share, actually $38 a share. Okay, so let's go look at the Leaps position and let's start to set this thing up. Let's go out to January 2020. You can also do January 2021. These are available now. Not as much open interest, but they're still available. We need to go at least one strike price in the money. So there's $35. We could go down to $30. Any of these three, 25 to 35. Okay. I'm going to tell you, just looking at these numbers, the $25 one looks really interesting. Well, this is really, really interesting what I'm going to tell you here. Let's start with the $35 one. For $35, to get the right to control American Airlines for the next 430 days, it's going to cost you $7.50 by $8, so you can get in the middle there, probably $7.75. Okay, you've got almost $3 of intrinsic value. So current price is, we'll call it $38 because that's the current price almost. Minus $8, we'll go on the high end here. Sorry, not $8, $35. I'm just erase that. Mess that whole thing up for you. $38 strike price. Sorry, $38 stock price minus your $35 strike price. That's what I was trying to get out. $3 of intrinsic value. Option premium, $8 minus your $3 of intrinsic value. That leaves you with $5 of premium value. That's what you need to overcome over the next 430 days. Okay, so let that PV as premium value. Now, if I come into the money a little bit more, let's say I came down to the $25 strike price. Well, if the stock is at 38 and I have the right to buy it at 25, I've got $13 of intrinsic value. How much am I paying for this? I'm paying only about $14.50, $14.75 is the actual ask. So how much am I paying for premium value? $1.75 is all the premium value that I need to overcome. Now, why would I not want to do this trade? Yes, Barry, premium value, time value, you can call it that. What's the problem with doing this trade? Why would I not want to spend $14.75 to get control of American Airlines at $25, and I have control for a year, and it's only going to cost me $1.75 in time value? What's a better way to do this one, Jason? If I were to buy the stock at $35 or $38, and if I were to buy it on margin, it's about the same amount of money. Buy the stock outright on margin. And now, no matter what happens over the next 430 days, you at least own it. You're not losing any premium value. There's no time decay kicking in against you. So in this is just a using your noggin and saying which one's a better trade. This is not as good of a trade as a Leaps position simply because you can buy the stock and do the same thing. And in this case, what would you do? You would do the exact same structure of what I've talked about tonight, but instead of doing the Leaps position, just replace the Leaps call with the stock. There's your ultimate caller, Jason. Okay. Now let's just come to the short term. Let's just run the numbers on this just so you have an idea. If we were to sell some options on this, we would go at least to $39, maybe $40. It's 10 days out. I bring in 29 cents. If we were to go a little bit more than 10 days out, try to get about a 30-day expiration. December 7th gets us there. 30 days out, 24 days out. $39, $40, you can bring in 75 cents. Could you, if your premium on this was $5, remember if we did the at the money with $5 premium, could you sell 10 of these and bring in over $5 over the course of 10 or 12 months? The answer is yeah. So you can make money on this. But again, you don't need to, because it's a better way to do it is to do the leaps, or is to do the stock position instead of the leaps, because it's a cheap stock. Let's come look at a more expensive stock, and I'll show you, I'll contrast these for you. Let me find one real fast. What's Boeing doing? Ugh. Citigroup doing. Yeah, it was one of my bearish trade setups from Sunday night. Costco doing. Let's do Costco. All right, so Costco's a $235 trade. I have earnings on this. No, not yet. All right. So Costco's a $235 trade. It's a little pricey, right? A little rich for some people's blood. Maybe you don't want to spend $230 a share. So instead of spending $230 a share, what if we came over here and bought the leaps? See, here's your logic, Jason. You kind of just think through these. And sometimes the collar's better. Sometimes the leap is more practical. January 2020, 430 days to expiration, $230. I can get control for this thing for $28 a share, $28.35. That's more practical, isn't it? Now, the problem is stock is currently at $234.14. We'll call it $234 for round numbers. If I buy a $230 leaps, I've got how much intrinsic value? Yeah, $4 of intrinsic value. How much is my premium on this? Well, if I spend $28.35 and I've only got $4 of intrinsic value, I got $24 of time value or premium value that I've got to overcome in the next several months. In the next 430 days. So how do I know how much I've got to bring in every month? Great question. So glad you asked. You've got to average at least $24.35. That's your premium divided by 12 months approximately. $2.02 a month. Okay, so now we need to come to the short-term positions and we look at, can I go 2 or 3 strike prices out of the money over about a month's time? That's 24 days here. Can I go to maybe 240 and bring in a couple dollars? The answer is yeah. It turns out I can. It's $2.61. So we could do this trade. We can make this trade work. Okay. What if I went deeper in the money? Let's go run the numbers on that, and I'll show you how your intrinsic value changes. So that was doing a $230 strike price. What if we went down to like a 210? Well, it's going to cost you a lot. It's going to cost you $43. Okay, but we are 238 minus 210. You're $28 in the money. $43 minus $28. That was just fancy enough that I have to use a calculator. I told you I'm not that smart at math. Now we've only got $15 of premium to overcome. Now it's a lot easier to overcome $15 of premium value than it is to overcome $24. But again, it costs you $43 a share. So you have to just kind of play with this and say, which one's going to work for me? Maybe $43 a share is too rich for you. So maybe you come in, you do the 220 at somewhere between 33.45 and 36. You could probably get this for $35 a share. So if you have a stock that's trading at 234, and you got the right to buy it at 220. I think I did that previous example at 238. Forgive me if I did. So you've got $14 of intrinsic value, $14 of your $35 approximately. You still got $21 to overcome. So, which one's better for you? I don't know that there's a better, but here's what I will say. You got an extra $10 of intrinsic value, and that's always valuable for you. So at expiration, intrinsic value is what matters. Here's the other thing that happens. The deeper you go in the money, the higher your delta. So you go from a 62 delta up to a 68, up to a 74. So it's going to move faster. Those things will be in your favor. But again, there's not a right or wrong, whether you go at the money or deeper in the money. There's really not a right or wrong on this. Okay. And then Thursday night, I'll talk more about this structural design. And I'll talk about the hedge. And I'll show you how you can turn this into a risk-free trade and some other cool things that we can do with it. All right. I know this was a deep class. Questions, comments? I got 8 or 10 minutes here. What you got? Jason says, much more practice, much more practical. But in the instance of when it makes more sense to do a collar, are there any downsides or gotchas with the collar like you have with the calendar spread? For instance, with the calendar spread, you have to watch the covered call and not let the leap get called out besides the cost of buy the stock. I don't think you wrote all of that exactly like you meant to, Jason, but I think what you're asking is it possible for you to lose money on the collar because you didn't have enough value there in the same way you could with a calendar spread? And the answer is no. With the collar, you own the stock. So you're not going to get into a situation where if you get called out, well, I mean, only if you sell the covered call at a lower price than your cost basis. Go ahead, Linda. I'll take a minute or two. Nicole says, deeper in the money leaps look less scary premium-wise. That's right, Nicole. Deeper in the money has less premium. Lower premium, it's a higher expense, but it's a lower premium that you have to overcome. Yeah, really, the collar and the covered call is a safer strategy if you've got the capital for it, Jason. That's right. Ricardo, is there a ration PV leap option? I think he meant, let me read the question before I judge what he meant. I think he means, is there a ratio of premium to leap option? Yes. It's not so much a ratio, Ricardo, but here's what you do. Take your premium. Take your premium, divide it by 12. And that needs to be your minimum monthly premium income. So if you have a premium of, say, $10, well, let's just go back to Costco. What was our premium? If we did an at the money, we had a premium of $24, right? So we divided $24 by 12. That left us with about $2 a month. So we need to be able to sell at least $2 a month worth of premium. So you come out about 24 days, 30 days in the future, take the December 7th expiration, which is 24 days. I can actually get a little bit more precise. December 14th. The premium that Costco's paying right now on about 31 days to expiration. Come on, pull these numbers in for me. If I went one strike price out of the money, it's $6. I want to go a couple out. Let's go to like the 240. I can bring in $3.95. This is going to work for you. This will work. So if I can bring in $3.95 every 30 days, then I'm going to make money on this thing. I'm going to break even or make money. And then there's other places that you're going to make money on it too, which I haven't talked about yet. Remember that underlying leaps position, hopefully you're going to get a gain on that. You're going to get real intrinsic value gain, and you'll make money there too. You could actually take this out to 245 and still bring in over $2.36. And if your strike price on this for your leaps position was 230, which is what we talked about, that would actually be a $15 intrinsic value before you would get to your 245 strike price. So you're getting closer. You're welcome, Ricardo. Oh, Paul says, I needed this class 4 years ago and my IRA still had money in it. Well, Paul, let's fix that for you and let me see if I can help you. I haven't seen your name for a while, but now I'm seeing you again, so I guess you're back. Let's see if we can't get you a strategy to dig out of your hole. Okay, got Nicole answered, got that. Nicole says, is there a notebook for the covered call? What are the guidelines for covered calls? There is, but I'll have to go dig that out, Susan, or go look up the blueprints class on covered calls. You're welcome, Jason. Yaz says, if you have any excess cash in the account and you buy on margin, will the purchase take advantage of the 50%? I don't know if I understand your question, Yaz. Yaz, if you have a margin account, let's say that you have $100,000 in a margin account. When you go for your, when you get ready to buy your stock, it'll say buying power 200,000. So if you have 100,000 actual cash, you'll have buying power of 200,000. That's margin. And so if you spend 150 of that, then you'll still have another 50 grand available. That would be the excess cash. Paul says, I needed this class. Okay, I already read that. Linda said, in the QQQ example, what do we do when the Q goes down in the leap option? Do we still keep the leap or sell to open? I think she meant sell to close, actually. Linda, let me address that in Thursday night because that's where the hedge is going to come into play. All right, because that's the next class, Linda. Susan, let me see if I can find that blueprint for you real fast. There it is. Susan, here's the blueprint for the covered call. Just posted that up there. That'll help you out a little bit. Okay. All right, folks. I have so many things I could tell you tonight, but I think I should probably let everything that I've just shared with you marinate and let it sink in for a little bit. I think that's what I need to do. So instead of breaking your brain and going off on a tangent for other stuff, how about I just call it a night and I tell you that I'm going to see you Thursday night. And Thursday night, we'll wrap this thing up. And during the day on Thursday, I'm going to say probably mid-morning, be looking for the email about the 45-day challenge and the 10-day mental diet and some of those things that I want to do around mindset for the end of the year. Okay, I think you're really going to like that. I didn't get into my great chat with Cheryl. I didn't get to share much of that with you tonight, but it will show back up at some point. So whether it's Thursday night or Empower Trader Sunday night, I'm going to share some great ideas with you. So it's going to be wonderful. You guys are going to like it. All right, you have a wonderful night. Any other last minute questions fired in here? Otherwise, I will chat with you later, and I'll see